Welcome back. Today we're looking at a report on Plus Therapeutics, or PSTV. It's arguing for a huge 1,000% upside based on some pretty optimistic analyst targets. Let's get right into the feedback.
Yeah, and right off the bat, it does a great job with that hook. You see the current price, $0.68? And then you see that average target of $7.91. That's exactly what this audience is looking for.
It absolutely is. The tone is aggressive, it's urgent, it screams 1,000% upside, which is perfect.
But
But for that kind of claim to really land, the path there needs to be a lot more solid. Which brings us to our first point. The analysis relies so heavily on that 791 analyst target, but the connection between the company's recent catalysts and that specific very high valuation, it's not fully established.
right, that's a critical weakness. The report lays out the facts perfectly. You've got the price, the target, the CNSide expansion in California, the Humana deal. It's all there. But for a sophisticated trader, a high-risk investor, just citing what someone else thinks, that's just the starting point. They need to see the mechanism. How do we get there?
Exactly. You're making a case for the possibility of a 10x return, which is great, but you're not showing the execution. The how. How does Plus Therapeutics actually get to a 7.91 valuation?
It's a big jump. Just going from, science project to actual revenue needs a much stronger bridge than just pointing to a data sheet.
It feels anchorless. And I think I see why it's structured that way, to keep the pace urgent and high level. But in doing so, it misses a chance to really engage the reader on a quantitative level.
Well, that's the thing. The ambition is there. It's high. But the defense of that ambition is a little low.
So the suggestion is to integrate some speculative revenue modeling, or, even just some key market penetration metrics, something that links directly back to those catalysts you mentioned.
Yeah.
This would ground that big price target in something more tangible, something based on execution potential, not just external consensus.
Exactly. And when you say speculative modeling, we're not talking about a full, complex spreadsheet.
No, not at all.
It's just about framing the execution. You can use the numbers that are already in the report to just illustrate the path.
I see what you mean. So you could use the conservative analyst target, the $2 one, as a kind of milestone.
Yes, use that as the first hurdle. You ground the massive 791 target by proving the $2 target is feasible first.
So the suggestion is to frame the impact of these steps, something like,
You could say, look, if the Humana national coverage leads to just, say, 5% market penetration in that first year in California, which is a huge market, by the way, that alone might justify the conservative $2 target.
that's highly actionable, because then the reader sees that 791 isn't just a dream. It's the end result of maybe 4 sequential goals, and step 1 is hitting that $2 mark, which is driven by these specific deals.
Right. It transforms the analysis from a list of facts into a real verifiable investment thesis. It answers the so what question. So what if they got the Humana deal?
The answer is, it's the first concrete step toward justifying that 10x target.
Exactly.
Okay, so transforming the valuation from aspirational to execution-based is a huge win. And that naturally leads into our second critique, which is more about structure, specifically how the analysis deals with risk.
Yeah. For a report that's aiming for this hype with facts tone and is aimed squarely at high-risk traders, putting all the risk factors into a separate reality check section at the end, it kind of diminishes their impact.
It really does. It feels like a required disclaimer.
Right? The flow is just so positive, all about the 10x upside, and then suddenly you hit the brakes and talk about dilution and cash burn. It creates this binary good news versus bad news feeling.
Which isn't how these investors think.
Not at all. High-risk traders don't think in binaries. They think in integrated risk-reward ratios. They want to see the risk and the reward discussed in the same breath. It shows the analyst actually understands the volatility.
When you silo the risk like that, you almost give the reader permission to ignore it, to just compartmentalize it and dismiss it, instead of seeing it as central to the entire trade.
I think you're right. And, they might be doing it to avoid scaring off less savvy readers, but in the process, they're kind of missing their target audience. The sophisticated trader sees the risk as the opportunity. I mean, the whole reason the stock is at 68 cents and not $2 is because of that dilution and cash burn. That volatility is the fuel for the potential move.
So the suggestion isn't just mention the risk earlier. It's to weave it directly into the discussion of the product and the expansion.
Yes, and you can tie it to the stock's technical pattern. That way, you keep the urgent tone by positioning this as a time-sensitive opportunity, something created by this dilution cycle.
You define the dilution not as some abstract threat, but as the actual entry point.
Precisely. The report mentions a chart pattern, the one traders call the gap and crap cycle in a context like this. This audience knows that pattern cold.
Right. The price gaps down after a bad capital event, the crap, and that creates a temporary, high-risk entry point for a potential bounce.
So if we link the dilution directly to that technical pattern, the analysis becomes so much stronger. You're using the risk factor to strengthen the timing of the trade.
Okay, so to make it concrete, when the analysis talks about CNET's side moving from science project to actual revenue,
You immediately follow up. Frame the dilution as the opportunity tied to that technical reality.
so something like, this transition requires massive capital, which explains the dilution and why the price just dropped 5% yesterday. You aren't buying a de-risked company, you're buying at the tail end of a gap and crap cycle, betting that cash from the California expansion hits before the next round of capital raising.
That is so powerful. It just elevates the whole discussion. You're turning this vague fear of dilution into a specific time-bound thesis. The risk becomes an active variable, not a passive disclaimer.
It's dynamic, it's urgent, it's perfect for this audience. That framing shift is very, very effective. Okay, so moving on to our final point. Let's look at the scope of that reality check section itself. Even if we integrate it, the content as it is feels, well, a little incomplete for a biotech analysis.
I agree. The focus on financial risks, cash burn, dilution is strong. It's essential. But the whole 1,000% upside rests on a very specialized diagnostic platform, CNSide.
And the reality check section doesn't really touch on the non-financial execution risks that come with scaling a platform like that.
Right. It only talks about the financial reasons the stock is at $0.68. It totally overlooks the operational side, the competitive risks. I mean, we're talking about expanding a novel diagnostic for spinal fluid cancers into California. That's a huge operational lift.
And if you only mention financial volatility, you're presenting an incomplete picture. The audience for this knows that the 791 target is just as contingent on the successful adoption and execution of CNSide as it is on the capital structure.
That's the crux of it, right? The financial risk determines if the company survives, but the operational risk determines if it ever actually achieves that 10x multiple.
For a biotech, that operational hurdle, getting doctors on board, hitting regulatory marks, beating out rival diagnostics, that's often the bigger challenge.
It is. So the suggestion here is just to briefly broaden that risk discussion. You don't need a deep dive into the medical science, but the analysis has to show an understanding that this complexity is a major risk factor here.
We just need a sharp, focused reminder in there, something that addresses the challenge of scaling a tool like this, but without losing that high-paced, urgent tone.
Exactly. So instead of just saying execution risk in a generic way, you could focus on market penetration. Something like, the downside here isn't just dilution, it's platform adoption. That 7.91 target assumes rapid, frictionless uptake of CNSide in a very competitive California market. Failure to meet regulatory timelines or even just slow adoption by key oncology centers could push back revenue by years and force another highly dilutive capital raise.
That lands perfectly. It adds a whole new layer of depth that really aligns with the material biotech, diagnostics, without getting bogged down in the weeds.
Right, it shows the writer has thought about the full spectrum of volatility here.
And it gives the reader confidence. Confidence that the analyst has accounted for all the reasons the stock is trading where it is and all the reasons it might struggle.
Which, paradoxically, makes the 1,000% upside claim feel more believable.
Okay, so that brings us to the summary.